Hello, can you hear me?
Hi, Grace.
You're asking if we can hear you? We can't hear you. Can you hear us?
Yes, I can hear you now. I'm just trying
But we
to.
can't hear you.
Okay.
Ah.
Can you now?
Yes, I can hear you now. Well.
Perfect.
Correct.
Thank
Super.
you so much. Hi, Adil. Hi, Sandeep. How are you guys doing?
We're both good.
Good, thank you.
All right. Yes.
Thank you for having us and looking forward.
Yeah, thank you very much. My name is Grace Mboko. I handle communications for the association. Sorry about that delay. We had a technical hitch. So give us about a minute. We log in our moderator of the day, that's Georgina Washuka, and then we'll transit to the starting of the session. Please bear with us.
Okay. So just Grace, just to ask that we have a presentation, but I wasn't very clear. Or do you want it to be a Q&A type thing? What was the intention?
So we have a program that we have. So we'll give each of you a slot to speak. You can share the presentation at that point. And then from there on, from there on now, we'll have the Q&A after that.
Okay.
All right, perfect.
Okay, good. Okay. We got this program added that they said I've done.
So in the meanwhile, let me just project the program so you can see how it looks like. So just to give you a brief of the session. Can you see it now?
Yes, I can see it.
Yep. Yes. So the concept will be having a welcoming remarks from our head of policy research and advocacy. That's Mr. Jobad Wanjohi. He's joining us momentarily. And then we'll have you speak, Mr. Sandeep. And then after that, we'll invite Adil just to give to comment on the impact of the changes within the Act. Thereafter, our moderator, that's Georgina Washuka, will take over on the Q&A session where we allow you to respond to our participants' questions. For this, we also encourage you, if you can, just respond to some on the chat or pick them from the chat and the Q&A for responding when you're speaking through, just to help us facilitate the session.
Okay, so my colleague Adil, who is, will be speaking later.
Yeah.
So whilst I'm speaking, anybody who puts questions, he will keep on answering them, right?
Yes.
So he will answer them as they are posing them. So that will help things move faster.
All right, no problem. But sometimes we find our members also send questions at the end of the session. So at that point, you can also even respond at that point. Thank you very much. Let's sort this out, then we can start.
Okay.
Hello, Joe.
Hello, Grace. How are you?
I'm fine, thank you.
Yes.
So on the call, we do have Mr. Sandeep and
Yeah.
yes, and Mr. Adil. I don't know if you have had a quick chat with them.
No. Good morning, Mr. Sandeep and Adil.
Hi, Joe. How are you?
Yeah. Happy to see you here, and thanks for
Thank you for having us.
accepting the invitation.
Thank you for giving us the opportunity.
Yes,
Really
exactly.
Are you all set?
Yeah, we all set. And I would propose, Grace, are we set from your side such that now we can start off?
Yes, we will. So
you
yes,
can quickly take us through the order.
so yeah, I just informed both Sandeep and Adil that we are just having you make welcoming remarks, and then you'll introduce Mr. Sandeep. We'll also introduce Mr. Adil. Thereafter, we'll have Georgina taking over the Q&A session. We're sorting out a technical hit on that part, but sure we'll have sorted that out. So you'll just, Job, you'll just inform our members to send their responses, the questions they have through chat and Q&A. And Mr. Adil will be picking up the questions and responding as they come through when he's doing the presentation. But also, Georgina will take over the Q&A session for any other question that has not been responded to. So that's the gist of it. Their cameras and sounds are perfect, so we're good to go with that aspect.
Okay, well noted, Grace, and then we can start off.
All right, I'll start the webinar right now. We had 300 people confirmed participation. So we hope to get about 150 of them. So once we get to about 30 people, just start the session. The rest will join in as we continue the conversation. Thank you very much, gentlemen. Please enjoy the conversation.
Thank you. Good morning, everybody, and thanks so much for joining this webinar. My name is Job Wanjohi, Head of Policy Research and Advocacy at Kenya Association of Manufacturers. Mine is to sincerely welcome you to this webinar, whereby we are unpacking the NSSF Act 2013, looking at various implications that are coming into place, especially over the judicial ruling, the appeal that is in place, and also what are the implications of this to the companies that are supposed to intervene on that ruling. So we have a panel of experts with us who are going to unpack for us. And what I'm going to encourage you is that you ensure if you have a question, you drop that question in the Q&A box so that we can answer those questions live. Or we can have the questions being answered during the Q&A session. But if you start off by writing your questions earlier, we will try as much as possible to respond to these questions. So welcome everybody. And I'm going also to make some few remarks on behalf of the CEO for Kenya Association of Manufacturers. And first is to recognize the directors present on this call. CAM directors, sector members, regional leaders, and also the sector leaders, CAM committee chairs and vice chairs, our guest speakers, our esteemed members, ladies and gentlemen, good morning once more. Thank you for making the time to join us this morning for the National Social Security Fund Act 2013 webinar. Social Security is a human right recognized by Article 22 of the Universal Declaration of Human Rights. Closer home, Article 43, 1E of the Constitution provides that every Kenyan has a right to social security and commit the government to take adequate measures to ensure social security of all citizenry. Social security is important to our country for several reasons. It provides a safety net for individuals who are unable to work or who have limited access to their forms of income. This can include elderly children, elderly citizens, disabled individuals, and those who are unemployed. It helps reduce poverty and inequality in society by ensuring that everyone has access to a basic level of income and healthcare. It can stimulate economic growth by providing a stable source of income to individuals, which they can then spend on goods and services, thereby contributing to economic activity. The NSSF Act 2013 attempts to secure the economic futures of Kenyans. It establishes the National Social Security Fund and provides for contribution to and the payment of benefits out of the fund. The Act provides for the registration of every employer and the employee with the fund. It further provides for the new rates that are significantly higher from the previous rates under the repealed National Social Security Fund Act Cap 258. The implementation of this act has been held up in court since its enactment in December 2013. Recently, however, the Court of Appeal, in its decision in the case of the National Social Security Fund Board of Trustee versus Kenya Tea Grower Association and 14 others, set aside the judgment of the Employment and Labor Relations Court, which had found the NSSF Act 2013 unconstitutional. The impact of the judgment is that the NSSF Act is now in force and NSSF has commenced its implementation. The Act has introduced provisions, and this is now noting the impact of the Act on business. It has introduced new provisions which will have several impact on businesses. The notable provisions are every employer must register themselves and their employee with a fund. An employer shall pay for the pension fund for each employee. The employer's contribution at 6% of the employee's monthly pensionable earnings. The employee's contribution at 6% of the employee's pensionable earnings deducted from the employee's earnings. So the rates to be implemented are as per the first year of the third schedule of the NSSF Act. They are subject to total contribution for both employee and employer of Kenya shillings to 2,160 monthly. Those with occupational retirement benefits scheme, including ABRA retirement benefit scheme or an individual retirement benefit scheme, should have it approved and registered by Retirement Benefit Authority for purposes of receiving Tier 2 contributions. This webinar, in conclusion, will unpack the impact of the Act on businesses and how to comply with the provisions of the Act. We are privileged to have speakers with knowledge and expertise in this area speaking to us today. They will brief us on what to expect from NSSF with regard to this Act and the way forward for business. Thank you for joining us this morning, and we look forward to an engaging session. So at the moment now, I want to invite Mr. Sandeep so that he can unpack the NSSF Act 2013 for us.
Thank you very much, Job. Good morning, everybody. I hope you can all hear me well. Job, is the sound clear?
Very clear, very clear.
Super. Please also allow me to share some slides that I would like us to go through. So I hope you can see the slides on the screen as well.
Yeah, we can see the slides.
Okay, super. So good morning again. And first of all, let me say how very honored we are as Zamara to have been invited by the Kenya Association of Manufacturers to present and participate in this webinar. I mean, this is obviously a very important piece of legislation As members of the Kenya Association of Manufacturers, you are some of the largest employers in this country. And this is a piece of legislation that affects everybody, every employer and every individual citizen in this country. And looking at the sentiment, when I talk to lots of people, including manufacturers, look at the commentaries on social media, this is a piece of legislation that is, having a lot of mixed emotion, a lot of sentiment, most of which is negative. And to a lot of the CAM members that I talk to, this is seen as yet another tax and coming at the wrong time, especially when the economy is not doing that great and businesses are struggling. And it's very natural to have this feeling and these concerns and apprehension, especially at this time, and for quite a weighty piece of legislation that for many of you is being brought in a bit of a rush. Now, allow me to share some perspectives which I hope that when you then reflect on them will hopefully enable you to see this legislation in a different light. Because from where I sit, this is a piece of legislation whose purpose is actually very noble. This is a piece of legislation that is important for our country and something that we need to do. It is a piece of legislation that improves the future financial well-being of all Kenyans. It ensures that every person will have a pot of money that they can rely on for their old age, as well as should something happen to them during their working lives. It is about fortifying our citizens against the economic, against the life cycle risks that they face and the economic shocks that they would face from time to time. But also, for a country like ours, such legislation can bring huge benefits as a valuable byproduct. The long-term savings that we would generate through the pension savings that will be accumulated, if they are harnessed properly into productive areas of investment, can bring huge dividends for our economy in terms of reducing the cost of capital, in terms of helping to build and develop our country's infrastructure, reducing the cost of doing business, because hopefully interest rates will be lower in the long run, and also helping to improve our capital markets and the supply of finance within our economy. And that's why I'm on record as saying that this is a piece of legislation that is in our national interest as a country if we implement it properly. And I'm hoping that as we go through this, you also look at this context. So I'd want to begin with a little bit of the policy rationale for this act. And Job in his introduction has done a very good, he's set the background for us very well. We will run through the act and talk more about the implications this will have. And finally, talk about some of the suggested next steps for employers in the audience, those with and those without retirement plans as of now. There is a Q&A at the end, but there is a Q&A and a chat facility. My colleague Adil, who is with me, will be responding to those questions. I mean, he's a very good typist, so he'll be able to respond very fast. And you can see that my hair is almost gray. Adil's beard is almost gray. So collectively, hopefully, we have lots of years of experience that we can share with you today. Okay, so let's look at the Act and some of its background. So all of us have been members of NSSF for all these years that we've been working. As employers, you have been contributing. The NSSF was established very shortly after independence. It's been there for 57 years. And what a lot of people don't realize is that contributions to the NSSF under the previous Act are actually at 10% of pay. 5% by employees, 5% by employers. Except that there has been a monetary ceiling on those contributions. And that ceiling has only been adjusted twice in the last 57 years. So the contribution started at 40 shillings capped. In 1978, they were increased to 80. And in the year 2001, they were increased to 200. Okay, so there's been a fix, even though there is a rate of contribution, it has become meaningless because the monetary ceiling has been very low. Okay? And this is why reforming the NSSF has been on the national agenda for many, many years. In fact, almost every government paper that you look at talks about reforming the NSSF and changing it and increasing the level of contributions. So this has been there on the policy agenda for at least 20 years. And if we look at Article 43 of our Constitution that Job referred to, It states that every Kenyan has a right to social security. And as he rightly pointed out, this doesn't mean that the government has to provide social security in terms of funding it, but needs to create the enabling environment and the framework so that all Kenyans can have access to social security, of which old age pensions is but a part. And this act that was enacted originally in 2013 was to give effect to Article 43 of our Constitution. As you know, it was originally due to take effect from 2014, but its implementation was challenged in court. It has been litigated since that date. The Court of Appeal reinstated the legislation on the 3rd of February 2023. But as you will all be aware, there has been an appeal that has been filed by the County Pensioners Association for a review of the decision of the Court of Appeal by the Supreme Court. And again, we don't know how long that process will take, or whether conservatory orders will be issued. Okay, so let's look at the policy rationale. Okay, so for the vast majority of our citizens, I mean, they rely on the NSSF. And again, let's face it, the NSSF again takes care of only a small fraction of our working population. We have more than 18 million Kenyans in the working population. Only 3 million of those earn a salary like you and I, or being in the formal sector. So all of us in the formal sector are members of NSSF, and we've been contributing 200 shillings. And you don't need a rocket scientist or an actuary to tell you that what that is going to produce in old age. Because if you take 400 shillings a month, multiply that by 12, that's 4,800, roughly 5,000. And let's take a Kenyan who joins the workforce at 25, religiously contributes for the next 30 years. By 55, the total amount will be 5,000 times 30 years is 150,000. And even if you hire the best investment managers and people, you will probably double or at best triple the money. So people will end up with 300,000 to 400,000 shillings. Is that enough to send people home into their old age home? Clearly not. The benefits that the NSSF has been generating are very derisory, woefully inadequate, and most people cannot survive on them. Okay. And the other point is that the NSSF has been a provident. So it only gives a lump sum benefit. There is no safety net of benefits. And whereas all of us like to receive benefits as a lump sum, the reality is benefits that are paid in the form of a lump sum are often misused, misapplied, squandered. Our experience and research at Zamara shows that people consume this money within less than a couple of years, sometimes even sooner. And if the aim is to provide retirement security, then it is better to provide it in the form of a regular income, no matter irrespective of the preference of Kenyans to get everything as a lump sum. The other important point to note is that there are very many employers in this country who offer retirement benefits by having a retirement fund, whether it's a pension scheme or a provident fund. But out of the 80,000 plus employees in Kenya, the number who do that is just over 3,000. So the vast majority of employers in this country do not provide supplementary pension or retirement provision for their employees. Even those who do, there are no minimum standards on contributions or benefits. And even for existing pension schemes, the outcomes that employees receive is not that great. Based on a study that we did at Zamara of more than 65,000 Kenyans who are members of retirement funds, the average pension that people receive in their retirement, expressed as a percentage of last salary, is only about 30 to 34%. As compared to a desirable target of 70 to 75%. So we have a situation in our country that firstly, most people are excluded, and this is 85% of our workforce. But even those who are saving are not saving enough. Even those existing retirement plans are not delivering enough. And if you look at the formal sector alone, it's 3.1 million people. Only 1 million participate in supplementary pensions over and above the NSSF. The remaining 2 million have only the NSSF to fall back on. And as I've explained, that is clearly not enough. Secondly, as a country, our savings rate has been very low at only about 10 or 11%. If we are to aspire to grow at the rates that we want to grow, and hopefully double-digit growth rates, the only way we can do that without borrowing heavily is to create our own savings and to use our own savings for growth. There can be no growth without saving. Okay, so long-term savings can play a very important role in pushing economic growth, in creating the jobs that we desperately need, in, as I said earlier, fortifying our citizens against economic shocks so that we can retain and create demand that you as manufacturers really want for your products and solutions, so that we can invest in the infrastructure in our country, in the power, in the utilities, so that you can access better services as manufacturers, and Kenyans in general can get better offerings. So there's a lot of benefits to having a system of mandatory saving, and many other countries in the world have cracked it. Why not us in Kenya? So these are the underlying considerations that prompted the NSSF Act. Okay, so this act, people didn't just suddenly wake up, I believe, to create it or to say we want to tax Kenyans more, but there were important policy objectives that needed to be achieved. Okay, the first of which is to say, how do we ensure that people are saving? How do we mandate them? And how do we ensure that people are saving and that they are saving at a reasonable and sensible level? Okay, so the first objective of this act is to increase the level of benefits that can be provided through an increase in the contribution rates. But to limit the impact on business as well as the pockets of Kenyans, those contributions are intended to be phased in over a period of 5 years. To guard against the practice of people taking everything as a lump sum, the new act says that most of the benefit has to be taken in the form of a regular income, because that is what will sustain people in their old age. There is a new provident fund that is being brought in to promote voluntary membership and contributions, and this is being targeted at the informal sector. Very importantly, this act, to me, is about a public-private partnership in the sense that those of you as employees, you an umbrella fund or a personal pension plan, and then be able to opt out of making the second tier of contributions to the NSSF. And this means that, yes, the contributions are going up, but there is a good portion of that can go to your own retirement fund. Okay, because of concerns about the old provident fund, and people were worried that what if there are hidden liabilities there, the old provident fund is being completely closed. Its assets and liabilities are completely ring-fenced, and they will not be mixed with the new. And there are measures within the act to strengthen the corporate governance of the NSSF, which a lot of Kenyans justifiably have had concerns about. Okay, so let's turn to the legislation now. And Job has already mentioned the effective date of the act is the 3rd of February, 2023, based on the judgment of the Court of Appeal. And this means that the statutory contributions at the higher rates are effective from the month of February 2023. And those of you who have processed your payrolls, irrespective of this uncertainty about what's going to happen at the Supreme Court, because the legislation is effective, it is our recommendation to all employers to say, deduct the contributions at the full rate. A lot of you who are looking at contracting out, the paperwork and all of that can be done. And the contributions to the NSSF need to be submitted by the 9th of March. Again, maybe that's too short a period of time to be able to achieve your contracting out. So let's see what happens there. And ideally, we have a lot of sympathy with the view that perhaps a grace period should be given. And indeed, in 2014, when the act was enacted, there was a 4-month grace period that was given by the then cabinet secretary. Okay, so for all intents and purposes, the act is effective. Unless there is a grace period given, then the contributions for the month of February, they need to be deducted at the higher rates, and you need to be ready to have them submitted by the 9th of March. Okay, as I mentioned earlier, the Act establishes 2 funds. There is the pension fund to take care of everybody in the formal sector, and the provident fund for those who are self-employed and in the informal sector. Job has already talked about this, the requirement to register by all employers. If you were previously registered, you don't need to do that, but you need to ensure that all your employees are registered, including those that you had previously not. because there might have been casual employees or people on contract over the rest. So because the definition of an employee under the Act is almost everybody, there are hardly any exemptions. And whether you have a contract that is written or orally, express or implied, the person needs to be registered with the NSSF. Okay, there's lots of questions that are asked about casual employees who work like a few days or sometimes just for a few weeks. Because of the temporary nature of their work, it is not possible to have contributions deducted at the rates provided under the Act. And my understanding is that the daily rate will be determined by the Cabinet Secretary and will be issued through regulations. The special contributions that were there in the old Act have been done away with. It's important even to appreciate that even under the Act, even the government is an employer, and therefore the government will need to meet its obligations under the Act. The only exemptions are for people who are entitled to being exempt under an international convention, or people who are not resident in Kenya, are employed here for less than 3 years, but who are contributing to a similar system in their home country. Okay, so I've already covered this about who will be members. So everybody who was a member of the old NSSF automatically becomes a member of the new NSSF. And everybody who is above the age of 18 and below pensionable age, which is defined as 60, is a member of the NSSF. I'm going to ask my colleague in a few minutes to take us through illustrations to explain how the contributions work. And important for everybody to appreciate that unlike the previous Act, where there was a very low monetary ceiling of 200, under the new Act, the statutory contributions are expressed as a percentage of pensionable earnings. These pensionable earnings are the monthly wages, but there is a ceiling called the upper earnings limit, but it's set at quite a high level. It is 4 times the average earnings in the country. Okay. Now, the Act defines wages to include all emoluments, but excluding emoluments that are fluctuating. So these are things like bonuses, commissions, overtime, and the like. Okay. So effectively, under the Act, the contributions should be deducted based on somebody's gross earnings. And for example, where housing allowance is paid, it would be deemed to be part of emoluments, and therefore contributions should be deducted based on including those. But there is a drafting error in the regulations that were issued under the Act, which seems to imply or which seems to suggest that for the time being at least, the contributions may be deducted based on basic earnings, but this is still subject to legal clarification. The contributions, as Job mentioned, are now at 12%, 6% being paid by employees, 6% by the employers. These contributions under the original Act are to be phased in over a period of 5 years. So there is a transition period in the Act. So the contributions will increase every year. So for the first year, the contributions are, the maximum contribution is 1,080 shillings, as Adil will explain in a couple of minutes. A portion of which goes to NSSF, a portion which can go to your own scheme. Thereafter, the contributions increase, but effectively in 5 years' time, most Kenyans will be contributing 6% of pay, and the employers will be contributing 6% of pay for them. But let's wait for the illustration so that this becomes much clearer. So first of all, the contributions are at 12%, but there are 2 buckets of contributions called Tier 1 and Tier 2 in the Act. So Tier 1 contributions are contributions based on earnings up to the minimum wage, which is currently about 15,000, but because of the transition, the Tier 1 contributions will kick off at a lower level. And then you have Tier 2 contributions, and this is anything above that. Okay. Now, Tier 1 contributions have to be paid directly to the NSSF. Tier 2 contributions, the default position is that they go to the NSSF. But if an employer elects to opt out, to contract out of the scheme of the NSSF, they can make the Tier 2 contributions to their own scheme, whether it is their own scheme sponsored by the employer or whether it's an umbrella fund that you participate in or a personal pension plan. And if you don't have one, you can set one up or participate in an umbrella fund. Okay, so Tier 2 contributions are not an option. They are to be paid, except that you have the option of paying them to an alternative arrangement and not to the NSSF. And for most employers, for most people with reasonable earnings, the bulk of the contribution is actually the tier 2 contribution. Okay, so this is the phasing in that was in the original act. So in the original act, the contributions for the first year are limited to 12% of salary, up to half the national average earnings, and then it progressively increases, and Aril will take you through how that will work. Okay, very quickly, the basis of benefits. I mean, like the scheme will operate like most other retirement funds in the country. Each individual will have his or her individual account. The benefits will be based on the contributions and the investment returns that are earned on those contributions. Interest will be allocated by the fund at least once a year, and when allocating the interest, the trustees will take the advice of an actuary or other qualified person. So every individual would be able to see their statement, hopefully, which shows their contributions, how much has been deducted, the history of contributions, as well as the interest that is being allocated, and the balance at whichever time somebody's looking at their statement. Okay, like whereas the previous act provided everything in the form of a lump sum, under the new act, the bulk of the benefit will be paid as a regular income. So when one reaches retirement age of 60 or early retirement age at or after 50, they can access their benefit. The pot of money will be used to determine the benefit. So somebody can opt to take up to 1/3 of their benefit as cash. The remaining 2/3 has to be taken in the form of a regular income. Okay, and there are different ways that can be done, either by purchasing what is called an annuity from an insurance company, or by doing a drawdown of the fund that has been accumulated. There are benefits that are provided on ill health. There are benefits that are provided to spouses and dependents when somebody unfortunately passes away while working. There is a funeral grant of 10,000 shillings. And if somebody is permanently emigrating from Kenya, the benefit can be paid in full as an immigration grant. Now, another important change is that whereas previously under retirement rules in Kenya, when somebody changes jobs, they can access up to about 50% of their benefit when they leave employment. But under the new legislation, the future contributions that are statutory cannot be accessed before retirement age. Okay, now let's turn to this contracting out, which a lot of employers are asking about. What does it mean? How do they do it? So as I explained earlier, there are 2 buckets of contributions. The first bucket, called tier 2, tier 1, has to go to the NSSF. Tier 2, you can contract out of. It doesn't mean that you don't pay it. You have to still pay it, but you can pay it into your own scheme. Okay, an application, there is a process that needs to be followed for this. An application needs to be made to the regulator, the Retirement Benefits Authority in the country. The employer needs to make a determination that it wishes to opt out. The RBA will ask which scheme will you be sending the money to. And as I said earlier, it can be your own scheme if you have one. It could be your umbrella plan if you participate one, or you could set one up or opt to participate in an umbrella fund of your choice. Okay, the RBA would review this application and come back to you. Once they give you their approval, you can start remitting the tier 2 contributions to your own scheme. If it means that in the next 1 or 2 months you have had to remit your tier 2 contributions to the NSSF and you wish and you've opted to opt out, you can then ask for those contributions to be transferred to your employer's scheme. Okay, and we've spoken to the RBA, and the RBA has indicated that they are willing to support expediting contracting out for those employers who wish to do that. Okay, now in order for a scheme to qualify to be a scheme that can receive statutory contributions, it needs to be registered with the RBA, it needs to be registered with the KRA, it needs to ensure that these tier 2 contributions are being properly recorded separately from the other contributions for the scheme, and that when people retire or exits, the benefits that are for the tier 2 contributions are paid in accordance with the Act. Okay. Interestingly, and very importantly, actually, the contributions at the prescribed rates are tax deductible for employers and for their employees. This means that the PAYE is deducted after allowing for the contributions. The investment income of this money is, as it accumulates, is tax-free. And when the benefits are paid out, they are paid out tax-free as well. Okay, so this is actually a very tax-efficient way of saving. It's actually a very generous treatment that is being offered under the Act. I must mention that there is a gap between the Income Tax Act and the NSSF Act, because under the Income Tax Act, yes, there is an exemption. There are contributions are tax deductible, but there is a monetary ceiling of 20,000 currently on contributions that are tax deductible. And on the way out, when benefits are paid under the Income Tax Act, the benefits are then taxed. There is a preferential rate of tax that applies, but they are still being taxed. Okay, so if the NSSF Act prevails, then all contributions, investment income, and benefits are completely tax-free. Okay. As with any piece of legislation, there are penalties and sanctions for breaches. The most important one that you guys need to know as employers is that if contributions are delayed, the penalty is 5% per month. Okay, so each month that you delay contributions, you are adding 5% on top. Okay, so this is something that employers need to be very careful about, because the compounding effect can really increase your costs as employers. I mentioned that with this legislation, there are lots of checks and balances that are brought in. There are measures to improve the corporate governance of the NSSF. The NSSF is subject to the regulatory oversight of the Retirement Benefits Authority. It has to comply with the requirements of the RBA Act, including the investment regulations. What a lot of people don't realize is that even as we speak now, more than 80% of the NSSF assets are actually managed by external managers who are licensed by the RBA and the Capital Markets Authority. The NSSF does not even hold the assets.
Job, can you confirm? It seems like Sandeep might have hit a technical glitch. Has he been kicked out?
Hi, Adil. Sorry, Job has stepped out a bit. I also realized that we were not able to hear Sandeep, so he's actually out of the.
Hello,
the
can
link.
anyone hear me?
Can you hear me, Adil? Hello.
We can hear you.
Yes, we can't hear the presenters. Adil.
Hello?
Silas, can you hear me? And Faith?
Yes, I can.
Faith?
Hello. Hi, Job. Can you
Hi.
hear us?
Yeah, I can hear you, Sandeep.
Sorry, Job. We seem to have had a technical glitch. My apologies. I hope you can see the screen again.
Yes, we can.
Okay, sorry about that, everybody. So as I mentioned, regulations have been issued under the Act. And I've covered most of the points that are relevant under those regulations. There are quite a number of gray areas that need to be dealt with, a lot of teething issues that will have to be dealt with. So, for example, I've already talked about the conflict between the Income Tax Act and the NSSF Act on tax exemptions, on contributions and benefits. There's a whole issue of casual employees and ensuring that the communication on the daily deduction is made. How do you deal with individuals who are with more than one employer? This definition of pensionable earnings, that where I said there seems to be a drafting error that needs to be clarified at some stage. And there are quite a number of things such as this which we come across every day as we talk to employers and look at how they can comply. Okay, so I want to ask my colleague now. Adil, you can take us through how these numbers work and what it's. So I'm going to mute and stop sharing.
Oh, you've stopped sharing as well. Okay, let me share. Good. It's exactly noon, so good afternoon, everybody. I hope you've been enjoying the session so far and getting something useful out of it. Give me 1 second to just share my screen. Let's get to the illustrations. 1 second. Okay, so before I go into the illustrations, let me just make a couple quick points. I think Sandeep has explained the formula, how the calculation of the contributions is to be done. And effectively, it's very simple in terms of the formula, but there's a few important things to understand, and I think a lot of us have had a challenge sort of grasping some of those concepts initially. I promise you it'll become much easier as we go through it a few times and look at examples. So remember, the formula is very simple. The contribution by each party, so this is the employee and the employer each, will contribute 6% of pensionable earnings. Okay, so you're taking 6% of pensionable earnings. And really the question is, what is pensionable earnings? And Sandeep has already explained that pensionable earnings is the lower of your salary and the upper earnings limit. Okay, what that means is we're effectively contributing 6% of our salary up to that ceiling, and we're contributing 0% of our salary above that ceiling. Okay, so that's really the crux of how to calculate the total NSSF contribution. To then split it up into tier 1 and tier 2 requires a second step. But remember, the splitting up of tier 1 and tier 2 is not changing the total obligation. It's only classifying them into the two buckets. So without further ado, let me jump in. God, what's happening now? Okay, so I've got 3 illustrations. The first one is somebody earning 10,000 shillings. The second one is a higher salary of 100,000 shillings per month. And the last one is 300,000 shillings per month, okay? And the reason for showing you those different salary bands is really to help contextualize how this will affect different employees in different positions. And there's another thing that I've added to my illustration. If you look at this slide, the first one is a 10,000 shilling example. There are 2 different columns. Okay, and I'm just getting out my laser pointer for that. So there's this column in the middle, which says year 1 of the transition. And the column on the right says assuming no transition. And before you look at, don't even worry about the numbers yet. I'm going to walk you through each and every one. Before we go into the numbers, I want to explain what I'm trying to convey here. Okay, Sandeep has explained that there's a 5-year transition period built into the Act. Okay, and under that 5-year transition, what will happen is the contributions are going to increase. And the way they're doing that is by covering more and more of your salary into the pensionable earnings definition. Okay, so remember, we have the upper earnings limit. We know that in year 1, the upper earnings limit is 18,000 shillings. It's not very high. Okay, so effectively, we are required in year 1 to contribute 6% of our salary on the first 18,000 shillings of our earnings. To the extent that you have salary above 18,000, that portion is not subject to the NSSF contribution. Okay, but what you need to understand is that 18,000 shillings is only for year 1. It is very transitory and it's going to disappear and move very quickly. So the column on the right is to show you that what would it look like today if we did not have the transition period. The upper earnings limit is defined as 4 times national average earnings. So in the last column, I've assumed national average earnings of around 40,000. And if we were at 4 times 40,000, the upper earnings limit is 160,000. So really, that's the idea behind the 2 columns. It's to show you today what we look like today for 2023, but also to show you what it looks like in the long term. If there wasn't a 5-year transition period, what would it look like? Okay, so without any more explanation, I think I can now dive into the numbers. So column 1, the example is a monthly salary of 10,000. So if salary is 10,000 and the upper earnings limit is 18,000, pensionable earnings is thus 10,000. The contribution is simply 6% of this, which is 600 shillings. Okay. Now, if we want to know the tier 1 and tier 2, we need to split up the pensionable earnings. 10,000 is the pensionable earnings. Tier 1 earnings are pensionable earnings up to the lower earnings limit, which under the year 1 rules is 6,000. So we have tier 1 earnings of 6,000. The tier 2 earnings is the balance, which is 10,000 minus 6,000, which gives us 4,000. If we want to calculate the two tiers of contributions, you just take 6% of each of those numbers. So 6% of 6,000 is 360. 6% of 4,000 is 240. If we add those up, we get back to the total contribution of 600, and that's really what it is. And in this example, the reason I picked a salary of 10,000, this member is already below the upper earnings limit. And you can see that they are contributing a full 6% of their salary immediately. And guess what? If the upper earnings limit increases to 160,000, it makes no difference, right? The pensionable earnings is still 10,000. The contribution is still 600. What will change is the buckets. Because in the long term, the lower earnings limit is effectively minimum wage. So right now, minimum wage is around 15,000. I've assumed a lower earnings limit of 15,000. In this example, the entire salary becomes tier 1 earnings, and the entire contribution will eventually become 600. So for a member in this category who's earning under 18,000, the total contribution, we're effectively where we're going. It's not going to change. The only change going forward will be salary growth. But the way it's classified will change over the transition period. Okay, moving on to the second example. Now we up the salary to 100,000 shillings per month. Okay, so let's start with the year 1 of the transition. If the salary is 100,000 and the upper earnings limit is 18,000, then the pensionable earnings is 18,000. 6% of 18,000 is 1080. And this is a number you've probably come across in all your communications so far from the NSSF, etc. 1080 is the maximum contribution in year 1 for each party. Remember, this is for one of the two parties. Either you're sitting as the employee or you're sitting as the employer and looking at this. So the total maximum contribution for each individual is 2160, 2 times that number. Okay. Now the 18,000 of pensionable earnings, we can now break up into tier 1 and tier 2. Tier 1 is earnings up to the lower earnings limit of 6,000. So it's 6,000. The tier 2 earnings is the earnings above that. So we take 18,000 minus 6,000, which gives us 12,000. We then calculate 6% of each of these buckets. 6% of 6,000 is 360. 6% of 12,000 is 720. And we add that up and get back to the 1080. Okay. But look at what happens to this member over time. If there was no transition today and we had a member earning 100,000, an employee earning 100,000 shillings, the upper earnings limit, if it was 4 times average earnings at 160,000, look what happens. The entire salary is pensionable earnings because the entire salary falls under the upper earnings limit. If the pensionable earnings is 100,000, 6% of that is now 6,000. Okay, so the contribution is significantly higher than the 1080 we're learning about today. And that's very important for you guys to understand, that the numbers are not going to stay where they are. It's going to depend dramatically on what salaries you pay your staff. Okay, if we want to now break this up, remember the lower earnings limit, ignoring transition, the lower earnings limit is minimum wage, which I said I've assumed as 15,000, which is approximately where it is. So the tier 1 earnings becomes 15,000. The tier 2 earnings is the 100,000 minus 15,000, which is 85,000. We then take 6% of each bucket and you get 900 and 5,100, which adds up to 6,000. So the key thing to point out here is to show you how the contributions are going to change over time. They're not going to stay around 1080 and they're going to increase to much more meaningful figures without much delay. It's going to happen relatively quickly. Okay. The other thing that you might want to pick out from here is that of the 6,000 shilling contribution, this is a hypothetical figure, of course, but of the 6,000 shilling long-term contribution for somebody at this pay grade, only 900 shillings of that is tier 1. 5,100 shillings, the lion's share of this contribution is actually tier 2 contributions. Okay, and remember that when it comes to tier 2 contributions, there are some options available to you as the employer, and you are not necessarily going to put it in NSSF. That is a decision you need to make. You do have to make the contribution, but you don't necessarily have to remit it to NSSF. So moving on to the last example. Over here, we have somebody earning 300,000 shillings. In year 1, guess what? It looks just like the 100,000 shilling examples because both of them are above the upper earnings limit. So pensionable earnings is still 18,000. The contribution in total is still 1080. The split is still 6,000, 12,000, which gives us the 360 and 720. So what are you seeing here? You're seeing that in year 1, anyone earning above 18,000, which is the upper earnings limit, the contributions will look exactly the same. The only people who will look different are people below 18,000. Okay, so that's something you can keep in mind. If we look at the last column, wages of 300,000 again, upper earnings limit of 160,000. So this high earner will still not have 6% on their full salary. They still have earnings above the upper earnings limit. So their pensionable earnings is 160,000. The NSSF contribution is 6% of that figure, which is 9,600. The tier 1 earnings is 15,000. The tier 2 earnings is 160 minus 15,000, which is 145,000. The tier 1 contribution, 6% of 15,000. The tier 2 contribution, 6% of 145,000, which is 8,700. We add that up and we get back to 9,600. So remember, tier 1 plus tier 2 will always equal the total contribution. Calculating the total contribution is not as complicated as maybe it has been made out to be. It is 6% of your pensionable earnings, okay? And again, the lion's share of the contribution in this example is tier 2 contributions, where there is some flexibility in what you do with that figure. So with that, let me stop sharing and pass on to Sandeep.
Sandeep, kindly unmute your speaker. Kindly unmute. We can't hear you. Sandeep, please unmute. Sandeep, please unmute. We can't hear you.
Hi, was I on mute all that time?
Yes, you are. You might need to
My
start
apologies.
again.
I'm not sure how much of that you got. I just was thanking Adil for taking everybody through this so eloquently and making it simple and hopefully showing that it's not as complicated as it looks out to be, and that hopefully you still have control over most of this money. Okay, so and then I mentioned earlier that this act requires every employer to review their existing arrangements, whether you have a retirement plan or not. There are a number of options and you need to be able to see how best you can exercise those options. So we prepare a simple decision tree that I hope can make it so that it makes it easier for you to see what options you have. So if you have a retirement plan currently, so let's say you run a scheme for your staff or you participate in an umbrella fund for your staff, you have the option to opt out or not opt out. Okay? The likelihood is that most employers who have an existing plan would want to exercise the option to opt out. I've already covered what you need to do for that, the application process that needs to be made to the regulator. You need to, some of the key things that you need to check are all your staff covered, because you need to make sure that everybody is covered. You need to make sure that at a minimum, the benefits under your scheme are at least the same or higher than those provided under the NSSF. You may need to make certain modifications to your scheme. For example, if it's a provident fund, you will need to provide that the tier 2 portion of the money that is contributed is is paid in accordance with the Act, i.e. paid as a pension and subject to preservation. We've already talked about the definition of pensionable earnings. And as I said, there is a gray area in the regulation, in the Act for the time being. And you also need to check that, does your scheme have a provision such that if there is an increase in the contributions to the NSSF, you can offset that against the contributions, you can reduce the contributions that go to your own scheme. Okay, so there's a number of things that you need to do quite immediately. As Zamara, for those of you who wish to, we would be very happy to help you in this process and handhold you to getting that approval from the regulator. Now, if you don't have an existing plan, you would need to ask, what do you do with the tier 2 contributions? One option is clearly to say, look, what the hell, let me just send everything to the NSSF. And you would then just take the contributions, that the tier 1, the tier 2, or just take the total 12, subject to the limits, and have that sent to the NSSF, okay? The other option is to say, do you want to opt out? In which case, the options are, do you start your own scheme or do you participate in an existing umbrella fund? And frankly, I don't believe anybody in their right mind would want to set up a scheme at this moment. It is best to participate in an existing umbrella fund. As Zamara, we have an umbrella fund, and there are also others in the market. I'm very happy to talk to you about how you can do that and make it very simple for you again. So I hope that this gives you, what decisions you need to make. Those employers who, for example, have gratuity arrangements where, they pay people at the end of service, 15 days or 18 days or whatever it is for the number of years of salary for the number of years worked. Again, you can look to see how you can make that, convert that into a pension, which is to say that you leave the past accumulated gratuity as it is, and then have the pension contributions for the future. If you have unions and you have collective bargaining agreements under which you have a gratuity, again, you can renegotiate those. And as Zamara, we have a lot of experience with this, and happy to help you do that as well for those of you who are in that situation. So I think I'm done. I'm able to almost hand back to Job. You can.
The question on the transition rates, the lower earnings and up earnings, could you just put that slide up for a second?
Okay, I will do that, Adil.
And somebody also asked where the 160 came from. So I've responded, but maybe you can talk through the slide.
Where the 160?
Yeah, which was 4 times 40,000. Remember, we were.
I see. Okay.
Assuming a natural.
So this is the transition in terms of contributions that is shown in the Act. Okay, that is in the original Act of 2013. Okay, so as both Adil and I mentioned, the eventual situation is that everybody will be paying 12% of earnings. For most people, their salaries are likely to be lower than the 4 times national average earnings. But the way the transition works is that firstly, on the total contributions for the first year, the maximum contribution is at 1,080 for the employers and 1,080 for employees. Thereafter, it will probably be double that because it is now the upper limit will then be 1 times national average earnings. Thereafter, it will increase in that fashion. Okay, I hope that's reasonably clear. The lower earnings limit, again, it was set in 2014, so it was 6,000 shillings then, and that is why you have the tier 1 contribution being 6% of 6,000, which is the 360 shillings. The next year, because the lower earnings limit under the Act was 7,000, it will be 420. Thereafter, it will be 480 shillings, and so on. Okay. All right. In terms of the 4 times national average earnings, actually national average earnings, I forgot to they're actually a bit higher now.
Yeah.
There's almost 60,000-70,000, but you were showing it for illustration.
There's so much confusion because half times national average earnings we're saying is 18,000.
Yeah.
But that's from 2014.
That's that was the 50%. It's 50%. So that's
but
it
that
was
was
36,000.
Exactly. So I just used 40,000 as an example. Right.
So, but they have been going up.
What
it's about 70,000. Yeah? So
right?
It's about 70,000.
70,000.
Yes, yeah.
Oh my goodness! I need to update my illustration.
Okay. So I hope that is clear. Job, I'm happy to hand back to you again. I just for those who have any questions or want to stay in touch with us or want to receive our material on this, We have a help email called nssfhelp@zamara.co.ke, but you can also scan that QR code and you'll be automatically registered. And we will send you the stuff, all the information that we share with our clients. We have a communique that explains this act in simple terms, and we'll share that with all of you who get in touch with us. And we also have responses to frequently asked questions, which we will also be happy to share with you. So thank you all very much again, and appreciate the opportunity to speak to you. I hope that we have maybe not allayed your concerns, but at least helped you to understand the act and some of the background and rationale to the act. Back to you, Job. I believe Adil has been responding to the question in the that are in the Q&A.
Thanks, Sandeep.
I'll stop sharing my screen now. So
can you hear me, Sandeep and Adil?
Good. Job.
Can you hear me, Mr. Adil? Hello?
Job, is Georgina going to be conducting the Q&A?
I can't hear you, sorry. Can you hear me?
Yeah, Georgina, I can hear you. Perhaps maybe Sandeep can't hear you for some reason.
Okay, yes, thanks, Nikhil. I don't know if they can hear you on the other side.
Hi, Georgina, can you hear us?
Yes, I can hear you, but can you hear me?
No, Sandeep, can you hear me? Let me call them, Georgina.
All right, thanks.
Georgina?
I think there's a technical issue with the sound. Some group cannot hear the other, but he can't hear me. He can't hear me.
The Q&A session is for the platform, not him.
Okay, what we'll do is members who wish to ask a question can maybe raise their hands and ask. I know most of the questions have been answered on the chat. So I will ask if Faith, let's try with you. Your hand is up and see if you can be able to communicate to the panelist. Faith, Gashie, kindly unmute and ask your question.
I'm good. My question was answered. Sorry about that.
Okay, thank you. Jacqueline Wamboi, if you have a questions, kindly bring it up for the panelists.
I know Georgina, Adil is still frantically responding to all the questions that are coming.
Yes, can you hear me now?
Yes, I can hear you well.
Oh, sorry. I don't know
Sorry,
really
the
what's
IT has not been working that great.
yes.
And I put my speakers on mute for some reason. I don't know why.
Okay, fine. Thank you. Thank you, Sandeep. I was just appreciating the presentations that you and Adil have done. And we had encouraged members to put in their questions on the Q&A, and most of them have been answered. But we have a few questions. We have a few minutes. We can take about 10 minutes and see what urgent or quick questions we can answer. So we have some few hands up. So I have Jacqueline, Isaac, and Lucy Joroge in that order. Maybe you can bring up your questions for the panelists. Jacqueline.
Hi, Georgina.
Yes, please proceed, Jacqueline, to ask your
Oh,
question.
sorry, I was confirming if you can hear me.
Yes, we can.
First, I want to say thank you for the presentation and giving us insight. So my quick question maybe would be to Sandeep. There's a point where he said, especially for employers who have maybe CBAs in play, that sometimes they have terms that override, I wouldn't say override, that maybe are more superior than the Employment Act. What is the procedure of maybe turning a service pay into a provident fund, or is it even possible, and what would be the procedure?
Okay, thank you.
That's,
Can we take the second one and then you answer both?
okay, okay.
Isaac, you have the floor. Go ahead, Isaac.
Okay, you can hear me well?
Yes, we can hear you.
Now, just one clarification that maybe I'll need from the panelists, and before I can proceed, just to say thanks a lot for the wonderful presentation. There is the financial impact to employers, because we are increasing the contributions from 200 to 1080. That may have some financial impact. So also based on what I'd asked before that had been answered in the chat, that there is a lobby group that is seeking for an appeal. So, and you did confirm that we go ahead and implement. So maybe if you can also clarify further about that. And then secondly, there is a circular from RBA, Retirement Benefits Authority, that talks of if you have a pension or a provident fund scheme that is in place by an employer, then it will be used to offset some of the contributions, especially on the tier 2. So I don't know whether you'd come by that circular by the Retirement Benefits Authority, and on whether their guidance on that circular was really in line with maybe whatever we've learned from this presentation, and also in line with with what the Act requires us to do going forward. Thank you.
Sandeep, go ahead.
Okay, thank you, Georgina. To Jacqueline's questions on this, on where you have a collective bargaining agreement in place and a union. So, Jacqueline, we have quite a lot of experience with helping employers to convert their gratuity under a CBA into a pension or provident arrangement. Okay, where what you do is you say that the gratuity that you get at the end of the period can be we can cost what needs to be put aside every month as a contribution. Okay, and in order to comply with the NSSF Act, that would need to be at the 6% minimum. But so we can help you to structure how do you replace the gratuity with the contributions that go in, which effectively aim to replicate or more than replicate what is under the gratuity arrangement. The accrued amount in terms of the gratuity that has been accumulated for all the previous years up to today, again, we can help you see what are the best options for that. One could be you still continue to retain that under your balance sheet and then pay it when somebody eventually exits your employment, plus what would be there under NSSF, plus the plus your own scheme if you have opted out. Or you can, if you have the cash flow, you can then say this accrued amount, I will transfer it as an opening balance into a new plan. And from our experience, employees love that because they see an immediate balance that happens. And there's also important ways to explain that, look, a gratuity is dependent on other terms and conditions, but when you have a pension plan in place, the members, the individuals' benefits, the unionized employees' benefits are much more secure. They are held outside of the employer. The money is being invested to earn a return. Also, if somebody is dismissed or removed from service for other reasons, that the money still belongs to the employee because it is their retirement benefit and no longer a gratuity benefit. So it's how you communicate and how you renegotiate these that make all the difference. And again, we are happy to help employers navigate that. Okay, the second question, sorry, I don't know if you want to make a comment.
No, I wanted to ask you another question that's come up on the chat, but you finished.
Okay, so let me take the question from Isaac. I mean, Isaac, I covered a lot of this and I believe maybe you joined a little bit late, but in terms of the financial impact to employers, the increase from 200 to 1,080. yes, that happens if you don't have your own scheme. Because for those employees who already have a retirement plan, hopefully that cost will be completely neutralized, because what you're paying as contributions to your scheme is higher than the 1,080, and which we would expect it to be. Okay, but if you don't, then of course there will be an increment to your cost. Okay, I'd also mention that the County Pensioners Association has filed an appeal before the Supreme Court for a review of the decision of the Court of Appeal. So this application has been filed, and then the process is ongoing at the Supreme Court, but recognize that no conservatory order has been issued. And until that is done, if there is no conservatory order, the Act legally remains in force, which means that for the February payroll, you need to have the contributions at the higher rates deducted. Okay. Now, on the circular from the RBA that was in the paper last week, then that was simply notifying employers and pension schemes that they may exercise the right to opt out of the second-tier contributions to the NSSF and instead pay them to their own scheme. And they had outlined the process that needs to be followed, which is exactly what I covered in the presentation a few minutes ago. I hope that answers your question, Isaac. But if there's any other, you can offline chat me.
Okay, great. Thanks for that feedback. Yes, we have Mr. Heman also on the call. Please put up your questions. Haman Bodia, would you wish to ask your question? Your hand is up. Go ahead. Please unmute yourself and speak.
Okay, this Rudolph of New April. I wanted to find out if, basing on the calculations, do we have to increase the allowance on tabulation for calculation of NSSF rate?
Okay, well, thank you. We'll take the next one from Julius so that the two can be addressed together. Julius, please unmute and speak. Julius, please speak up. Julius, we can't hear you speak. Can we try Alan Nyavuke?
Okay, good afternoon.
Yes, good afternoon.
I wanted to find out on the tax benefit, assuming maybe a two, assuming already you are on the maximum allowance for tax purposes, you are getting the relief maximum. So what happens now when you add an additional contribution now from NSSF, maybe say from when it starts increasing those tires? Because I think the maximum, as Mr. Sandeep had indicated, is 20,000 per month. So if it goes to over 25, is there any benefit? Why should you are not getting any tax benefits? Thank you.
Okay, thank you. Sandeep, you can answer those two, and then we'll see if Julius is able to ask his question, which we'll take together with that of Penina. Julius?
Yes, hello.
Yes, Julius, we can hear you now, please.
Okay, thank you. Good afternoon, Georgina. Good afternoon, Sandeep. My question is around the integration of the pension scheme and the NSSF Tier 2. I'd like Mr. Sandeep, in one of the write-ups I read from the farm, Zamara, that is, there is an element of where we can mitigate the increased cost through integration of the two funds. Thank you.
Okay, thank you, Julius, for that question. Maybe we can take those ones before we lose it. We lose the questions, Mr. Sandeep.
Okay, so thanks, Georgina. To the first question from Hemant on our allowances, our contributions to be paid on allowances. So as I had explained, the definition of pensionable earnings under the Act is that the wages, pensionable emoluments are earnings including, all earnings but excluding fluctuating emoluments, okay? So if it is a fixed allowance such as housing allowance, then the intention of the Act would be that that contribution should be that should be included when you're determining the contributions. But things like commissions, bonuses, and overtime can be excluded. I also mentioned, however, that there is a drafting error in the regulations, which seem to suggest that at least for now, the pensionable earnings can just be the basic salary, i.e. that all allowances can be excluded. But this, as I said, appears to be a drafting error, and we are seeking some legal interpretation on how best this should be treated. Okay, so I hope that answers your question, but my own sense would be, I'm not a lawyer, but that for the time being, one could argue that it is only basic salary that is pensionable. Okay, to Alan's question around tax, Adil, do you want to take both of the next ones, or do you want me to? The tax one is that, the KRA has a limit of 20,000. When these contributions, when you have this increased contribution and you get over the limit, and even in future, what will happen? So, Alan and Church, maybe I will respond to it. So, if the NSSF Act prevails, then even as the contributions increase, as long as the statutory contribution is below the 20,000, or even if it goes above the 20,000, my sense would be that, look, that Act gives that Act says that all statutory contributions are tax exempt. Okay. Now, with this disharmony with the KRA Act, this will need to be resolved at some stage. Way back in 2014, we had written to the KRA to give us guidance on this, but they didn't respond. We will need to do that again and guide employers properly. But for now, my sense is that it would not apply given the low level of contributions that are there. Julius's question, I'm actually going to ask Adil to deal with it.
Okay, thank you. So we can take questions from the three ladies. We have Penina, Anne, and Caroline in that order. Please unmute and speak. Penina?
Okay, can you hear me now?
Yes, we can hear
Georgina,
you.
maybe you can confirm for me?
Yes, I can hear you, Adil. Hello, I can hear you.
Okay, wonderful. Sorry, we're a bit slow with technology. I'm better with spreadsheets and numbers than I am with computers.
Okay.
Okay, so there was a question about if you already have a pension scheme, Zamara has advised there's a way to mitigate some of the additional costs, and how would that work? So to answer that question, if you look from a global perspective, it's not abnormal in a pension scheme for the contribution rates or the benefits to be integrated with the national system, okay? It's not very common in Kenya because our national social security scheme is simply 200 bob. So it's insignificant. So a lot of schemes just define the contribution rate as X%. We shall contribute 10% of basic salary, or we shall contribute 5% of basic salary, whatever that may be. It makes no reference to NSSF. But there is an option to say that what if your contribution rate was defined as the employer shall contribute 10% of your salary to your pension scheme, less any contributions made to the National Social Security Fund. Okay, so that is what we anticipate a lot of employers who already provide pension, that's what they're going to do. You see, you need to consider pension in a holistic manner, that if we're trying to target a specific level of benefit, a specific level of security for somebody in retirement, we need to save a specific amount. But that saving amount is a total amount. It's not necessarily just from your private scheme. It can be a combination of different buckets. It can be your private scheme plus, in this case, the NSSF. So for those who already have schemes, we anticipate that a lot of them will will offset the NSSF contribution from their existing pension contributions. And for you that may decide that you want to set up a pension scheme, your initial feeling might be, let's set up a pension scheme simply for contracting out. Let's set up a pension scheme just to park the tier 2 contributions. But over time, what I would urge you is to look at your pension benefit as a meaningful component of your employee compensation. It's a meaningful benefit that you offer. It's a competing and retention tool that you use for staff. 6% and 6% is a great start. Let's not miss that point, that we are going from saving nothing effectively to making sure that everyone is at least saving 12%. But as an actuary, I can tell you that, you know, the magic number is over 20%. If you start saving at an early age, like when you first start working, you need to save about 20% to give yourself a comfortable retirement. So 12% gets us towards that goal, but it doesn't necessarily take us all the way. So for those of you that initially set up a scheme for contracting out only, over time, you might want to consider whether some of your benefit enhancements should be in the form of higher contributions to your pension and not just purely complying with the law. But of course, that's not necessarily something you'll be looking at immediately. Thank you.
Thank you, Adil. So we have Penina and Anne. Go ahead, Penina.
Thank you, Wachuka. You hear me?
Yes, we can hear you.
Okay, I just needed a confirmation as to the remittance tier 2 to NSSF, especially noting that organization already has a pension plan. We've been trying to seek clarification of the same, and we just want an authoritative confirmation that yes, indeed, we must submit or remit the tier 2 to NSSF until the time or until such a time that when we shall have that certificate of from the RBA.
Okay, thank you for that question, Penina. Anne Wafula. Please unmute and speak.
Good afternoon, Georgina.
Good afternoon.
Yes, this is Yakub on behalf of Anne.
Go ahead.
Thank you. Georgina, Adil, and Sandeep, thank you for the presentation. We would just like to seek a clarification, and I think we are quite impressed with this presentation from Zamara. And we are looking at tier 2. If we opt out from remitting to NSSF and intend to use the services of Zamara for submitting our tier 2 contribution to Zamara, would there be any service charge or any cost applicable additional? Number 2, secondly, after what stage can any employee redeem his contribution? I hope I'm clear. Thank you.
Yeah, thank you for that. Maybe a third question can come in from Caroline.
Hello?
Yes, we had you. Thank you. Your questions have been well received. We'll respond to them as we start winding up the session. So Caroline or Tabitha, one of you can go for the questions, and we have the final round of the presenters answering. Then we get to closing the session. Yes, go ahead.
Yeah, this is Caroline. I just want to appreciate the presentation from Mr. Sandeep and Anil. And my question is looking at the communication to the employee. As the notice for paying the contribution has been said that it should be effective from February. And some of us, you find that our employees are not aware, depending on the living standard of today. What have you done about it so that we get time to communicate to the employees? Because when you do a contribution and they just realize that 1,080 has been deducted and they are not aware about it, or maybe you tell employee that today you are going to be deducted this because it is a rule that has been passed that we should implement the NSSF deduction. So what are we doing to communicate to the employees who are not aware in terms of awareness? Thank you.
Okay, thank you. We'll take those questions back to the presenters to answer them. Tabitha, maybe you can type your questions on the Q&A. We will need to start winding up. Tabitha?
Okay, my question goes to Mr. Sandeep. I wanted to understand, currently we are doing 5% for the pension. So now when we decide to opt out, do we need to do 6% or can we remain at 5%? Thank you.
Thank you. I think I'll close that for the live questions and we go back to the presenters for answering that, the questions that have been set out.
Okay, Georgina, I'll respond. Okay. Okay, Georgina, I'll respond to some of them, and there's one that I'm going to ask Adil, and this is the one from Penina on contributions. Okay, so the one from Caroline around the communication to staff, and that's a very important one, right? So it's because all of a sudden, if somebody sees another 880 shillings deducted from their payroll, I mean, they're not too happy with you. So it's very important that there be a notice and an individual communication to your employees that, look, there has been a payroll deduction made for contributions to the NSSF. And ideally, it would be really good if that were accompanied with some explanation as to about the act and also what you are going to be doing going forward. You know, do you have your own scheme? Are you going to be setting one up so that you could actually try and make this a very positive message? And I think Adil brought out this point that, look, one of the reasons why it's important for all employers to review their existing arrangements is because this is a good time to look at your entire employee benefits proposition. You might not say it's the best time in terms of how the economy is, but it's a good time to look at things to see, can you have your employee value proposition looked at better? You know, are there overlaps? Are there gaps in what you offer, and how can you structure this, and how can you communicate these things better? And there are a lot of dividends that you can gain in terms of better relationships with your staff by doing so. Again, happy to help. Okay. Tabitha's question around contributions that, if your current pension scheme has an employee contribution at 5%, employer at 5%, do you need to straight away increase it to 6%? Tabitha, you don't straight away need to increase it to 6% because the expectation is that your current 5% is still higher than the tier 2 limit of 1,080. Okay, so you should still have, you don't need to straight away adjust it. You can adjust it over a period of time. Okay, Adil, you seem to not, is that?
No, it depends on the salary level, right?
Yeah, depends on the salary level.
So if you've got somebody earning 10,000,
yeah,
the 5% won't cover it,
yeah,
but they will obviously have to just contribute more, and there will be no extra pension contribution.
Yeah. Okay, so Tabitha, I hope that's clear. To Mr. Yakub's question on tier 2 opting out, if you were to move to Zamara, would there be a service charge? So yes, of course, Yakub, there is a cost to administering pensions, but it will be met from within the contributions, right? So you don't need to pay anything over and above the tier 2 contribution or whatever you agree is the contribution to our plan, for example. Okay, so you could participate in the Zamara umbrella fund, be a participating employer. There are more than 200 other participating employers. You would have your own benefit structure, which will comply with NSSF, and we would then handle the entire process in terms of contracting out for you and making sure that all the other benefits come to you, and including how helping you to your staff to see the value that they are getting from the contribution that you are paying. And in your second question, after what stage, what can an employee redeem their contribution? So under the Act, the benefit is payable on retirement age, which is at or after age 50. But if somebody either falls ill, becomes disabled, the benefit is payable. If somebody unfortunately passes on, then the benefit is payable as well. Okay. Adil, the first question was from Penina, and fortunately, I can't read my own handwriting. Penina, could we request if or Georgina, do you remember the first question from Penina? And Adil tells me actually that Penina had put it on the chat, on the Q&A, and he has responded to it.
Okay, that's okay, thank you.
Okay, if it's okay, I can repeat it. I was asking, we've been making inquiries regarding remission of Tier 2, especially for companies that already have pension schemes that are already registered with RBA. Now, we wanted to know that during this pendency that we have not yet received the RBA certificate, is it mandatory then that we must contribute to NSSF during this period?
Oh, no,
or
I
can
get
we
your question
continue
completely. Yeah, no, Penina, I get
remitting
it.
to the pension?
Yeah, Penina, I get your question. So you're asking that during this period where that, so you've made the application for contracting out, but as you wait for the RBA, can you hold off paying the Tier 2 contributions? So the first point I would make is that, look, you need to have deducted the Tier 2 contributions. You have till the 9th of March. To the extent that the RBA can give you the certificate by the 9th of March, then I believe you will probably be okay to have those contributions go to your own scheme. But if you haven't, then you would need to have sent them to the NSSF. And up to the time you get your contracting out certificate from the RBA, you will need to send those contributions, the Tier 2, to NSSF. However, once you get your certificate, you are able to ask the NSSF to transfer that money back to your own pension scheme. Okay, Penina, does that answer your question?
Yes, that does. Thank you so much, especially with the clarification that NSSF can still transfer back whatever amount you would have remitted to the scheme.
Yeah, correct.
Thank you. Okay.
Thank you. I hope we have tackled all the questions that were shared online by voice.
Adil has got a few more.
Like 2 or 3. I'm about to finish them.
Okay. Adil?
Yeah, there's just a couple more Adil is saying, but he's responding to them on the chat.
Yes. Well, as he responds to the questions that are on the chat, I want to take this opportunity to thank the presenters for the time well spent, for the great presentation and clarity that has been offered during this almost 2 hours session. I think we are in uncertain times, and a lot of knowledge sharing is very critical to ensure that our business operations are not interrupted, and at the same time that we are compliant with the requirements of the laws of the land. So we apologize for any sound tech that may have taken that took place. I think with this kind of setups, we cannot avoid some of these hitches. So I want to confirm to the members present that we will be sharing the recording of this session. It's been taking place, and we shall use the questions that have been shared to come up with the FAQ. And this one will also be built up on one that is already existing with Zamara. And this will be shared back to you with the thank you note for taking time to attend this. I want to thank the CAM team behind this, our communications team, for putting this together. We appreciate you, and we want to pass our greetings and well wishes from our board's leadership. They've not been able to join here, but Job also was with us from the management, but had to step out. Thank you all for taking time to have joined this webinar. And thank you very much to the Zamara team. And I want to take note, you've done well. You've been able to answer about 86 to almost to 90 questions online. I hope members, we have been able to learn something out of this. We're way past over the scheduled time by I think about 9 minutes. So I will ask if there's anything that the Zamara team would like to say. I know you've shared your contacts, and members have been asked to contact them for any queries. You've asked us to scan the code there if we want to directly reach you. So I'll just give you a minute, Sandeep, and then I'll just close the session. And Thank you, everyone. So Sandeep, if there's anything that you'd like to say from Zamara's perspective.
Not specifically, Georgina, just to once again thank the KM for inviting us, giving us an opportunity to talk to your members. I hope that this session has been useful and that we have been able to address your questions and hopefully allay a lot of your fears and concerns about the Act. Georgina, if I may, just to mention that this evening as Zamara, we have a webinar for HR to help you to understand in terms of the payroll, and we'll be running through an Excel spreadsheet that shows how the tier 1, tier 2, and the contributions work. So our head of people and culture will be doing that, Raymond. So if you're interested in joining that, also scan the QR code and we will send you the link for that webinar that's happening between 6:30 to 7:30 this evening.
Okay.
So, yeah. So thank you, Georgina, and everybody. It was a pleasure meeting all of you.
Thank you very much, Sandeep, Adil, and Nikhil Dodia from Zamara. Thank you, Silas and team. So guests, you can leave at your own pleasure, and hope that you'll be able to join the evening session for HR professions. Have a good afternoon, everyone.
Thanks, Georgina.